Thank you for joining Money Simplified, your guide to money and mutual funds, presented by Franklin Templeton Mutual Fund. We appreciate your participation. At PersonalFN, we are committed to helping investors achieve their financial goals and objectives. Our core proposition is built around unbiased research and financial planning. We wish to thank Franklin Templeton Mutual Fund for partnering with us in this investor education and awareness initiative. Welcome to the session 6 of Money Simplified, your guide to money and mutual funds. We are glad to have you with us for our 6th session on Introduction to various asset classes, equity, debt, and gold. So let's begin our session on Introduction to various asset classes, equity, debt, and gold. Successful investing is not an easy task. Whenever you plan for your investments, you need to plan them well. Before investing your hard-earned money, you need to be well aware about the instruments where you are investing your money. You need to prudently select the asset classes for your investments, as each asset class carries their share of positives as well as negatives. So through this session, we will take up 3 major asset classes, equity, debt, and gold, which are popular amongst investors. But before that, let us again understand what is investing. As we mentioned in our session 1, investing is an act of laying out money saved for productive use with an expectation of earning return higher than the inflation to preserve purchasing power of money. So it's a process of making your money work for you instead of simply stacking it in your vault, bank locker, or even your cupboard. In simple terms, by investing, you purchase an asset with your money with an expectation of generating income or profit. Assets are broadly classified as physical assets and financial assets. A physical asset is an asset which has value and can be touched, felt, and used. An investor buying land, a house, a painting, or gold can touch and feel them. Such assets are in the control of the buyer and can be put to use as per the choice of the buyer. But physical assets also carry a storage or a maintenance cost. Financial assets, on the other hand, is an asset which is bought in the form of certificate which entails the buyer for the benefits as a beneficial holder. But such entitlements cannot be touched or felt. Equity shares, bonds, debentures, fixed deposits, provident funds, mutual funds, etc. are some of the financial assets that an investor normally invests in. The benefits derived from these assets depend upon the performance of underlying company or issuer. Historically, in India, people have been more comfortable with physical assets which have drawn a large portion of their wealth. As physical assets held by an investor do not benefit the economy, they are termed as unproductive assets. In order to help the economy grow and in turn benefit from the growth of the economy, people need to emphasize a portion of the investments towards financial assets. There are various investment avenues. Number 1, equities or stock, a most commonly thought of as a high risk, high return investment avenue. Then the next is debt or bonds. People often construe debt markets to be safe, but it does carry risk, which we will tell you as we progress with the session. Then the next is fixed deposits. This is one of the most popular investment avenues in India, which is considered to offer decent and fixed return. Here the risk is relatively less. Precious metals. In India, precious metals like gold and silver have sentimental value attached to them. We usually buy them on auspicious occasions and consider them as a security for unforeseen events. Then the next is commodities. As inflation keeps growing at a healthy pace, the price of goods and services keep on increasing. In order to reap the benefits of increasing prices of goods, people nowadays consider to have some exposure to commodities as well. Real estate. The house you live in is meant to fulfill your basic need for shelter. Although it may appreciate over time, it shouldn't be purchased with an expectation of profit, because after all, the house you live in is a primary home for your own dwelling. In anticipation to make profits, some people buy multiple houses, apartments, lands, etc. to rent out or resell at a higher value in future, which form the part of their investments. Art. Some people consider valuable art objects like paintings etc. as a status symbol, and some buy them with the intention of reselling them for a profit. Those who understand it tend to spend huge money on art and consider them as an investment. While commodities and art may be classified as an investment avenue for informed investors, such investments carry a risk of physical depreciation or damage or perishable loss, and also require storage costs that may cut into ensuing profits. On the other hand, real estate investment carries complex and time-consuming procedures. This is in a way makes them more unfriendly for new investors. So in this session, we will emphasize on relatively simple investment asset classes like equity, debt, and gold. To begin with equity. Equity means ownership. When you hold equity in a company, you are a beneficial owner of the company, so we can say that you are a part owner of that company. Equity holders are the owners of the company, as I said, as they entitle you to become one of the several owners who are called the shareholders of the company, and you can participate in the company's growth. Companies issue equity to raise capital, which may be used to develop their business or repaying existing debt, etc. There are some advantages of equity investing. As an equity investor, you enjoy ownership in the company. Equity shares reflect partial ownership in the business of the company. As an equity shareholder, you enjoy the rights of the owner based on the level of stake you hold in the company. You also get an opportunity to vote on important business decisions. Earnings in the form of profit sharing through dividends. After disbursing the preferred payments, profit-making reputed companies share a part of their profits with the equity investors in the form of dividend. Returns in the form of capital appreciation is also an advantage of investing in equity. Over the long term, shares are likely to produce capital gains through increase in share prices. As shares of a listed companies are traded onto the exchange, the net worth of equity investors is influenced by the share price movement in the markets. If there is an appreciation in the share prices, your opportunity of making gains from equity investing increases. Ability to generate returns that are higher than inflation. Yes, equity markets are exciting, dynamic, and of course have the potential to provide high returns over the long term. Historically, equities as an asset class has outperformed other types of investments over the long period of time. Equities have proved their ability to generate returns higher than the rate of inflation in the long run, and hence they are generally considered as a crucial instrument while planning one's long-term investment strategy. Limited liability. As equity has limited liability feature attached to it, as one of many co-owners, you're personally not liable in case the company fails to meet its obligations. This means, despite gaining from the benefits, you're personally not supposed to bear the losses. At the most, what you can lose is the value of your investment. Tax benefits. As per the current taxation laws, equity investments carry favorable tax status. The dividend income is completely tax-free in the hands of shareholders. Even the long-term capital gains you make by holding your equity investments for a period of more than 12 months are not taxable. However, short-term capital gains are taxable at the rate of 15% plus the applicable cess and surcharge. Liquidity. One feature listed equities offer is liquidity as compared to other investments like real estate, where it may take time to liquidate your investments. You can sell your equity investments and get in your money in 3 to 4 business days. Equity markets have a well-regulated structure. Equity markets, since they have a well-regulated structure, the investors are protected. In India, equity markets are regulated by the Securities and Exchange Board of India, SEBI, who monitors and keeps control on any wrongdoing that may hamper the investors. Equity investing helps in economic development of the country. As an equity investor, you invest in the business of the company. The company can use this money in financing important projects, which creates employments. More employment leads to more consumption of goods and services offered by the companies, thus supporting projects of companies offering these goods and services. It also boosts the revenue collection of the government in the form of direct and indirect taxes, which, if spent prudently, leads to economic development. But along with the advantages, there are some disadvantages to equity investing. They are: equity does not guarantee return. Equities do not guarantee any return to investors. The return on one's equity investment depends on the performance of the company. A well-managed company can do well and deliver for its investors, while a bad management can lead to failure and loss of capital to investors. Equity investments carry high risk. Equities are generally known as high-risk, high-return investment proposition. This is because the price of shares of a company can swiftly rise or fall based upon the news flows or sentiments prevailing in the equity markets. The investor is tied by the risk of capital depreciation if the market prices of stock move lower than his actual purchase price. However, actual risk is accounted when investors happen to book loss by selling the stock at lower prices. Need proper skills to identify good equity stock. It is not easy to identify a good equity or a stock for one's portfolio. Identifying the right stock requires skills and ability to understand stocks on various parameters. You need to be more cautious. Proper analysis across qualitative and quantitative parameters and comparison within the peers is a must while zeroing on a good stock. Equity needs regular monitoring. As an investor, you need to regularly monitor your equity investments and keep track of qualified news related to the company you have invested in. Such news have huge influence on the share price, which decides the health of your investment portfolio. News flows impact equity markets. Human beings have a tendency to get carried away with attractive money multiplying tips on stocks that they receive from friends or some stockbrokers who put their interests first. But we think that you ought to be careful and not fall prey to such misleading tips or news. As we said, you need to be cautious and do proper analysis before investing in equities. Equity investing is suitable for investors with certain level of risk-taking ability. Equities, being volatile by nature, carry risk to capital in near term and hence may not be suitable for investors looking for safety of capital. Investors investing in equity should have the appetite for high risk. You should do your risk profiling to gauge your risk appetite well before considering equity for your investment portfolio. Investors eyeing for high returns. Historically, equities has been the asset class that has delivered better inflation-adjusted returns for its investors in the long run. The quest for high returns attracts investors towards equity markets. Though equities are known to be high return generating asset, they should not be considered as an instrument to double your money within 24 hours. Equity investing is not for gamblers. Investors having a long-term investment horizon, for them equity is the best asset class. Equity investment requires patience. If you start planning for your retirement at an early age, equity could potentially be an asset class you could consider. The earlier you plan, the better it is, and equity can play a crucial role in getting close to achieving your long-term financial goals. Investors ready to invest small but regularly. If you have a regular income and manage to save a proportion of your income after providing for your contingencies and necessary expenses, you should not leave your money idle in your bank savings account. You can plan your regular investments based on your risk appetite and time horizon. Opting for a systematic investment plan popularly referred to as SIPs, in equity mutual funds is a good option for investors who want to follow a disciplined investment approach. Such investments can help in gradually contributing towards long-term wealth creation. So how to invest in equities? Broadly, you can invest in equities in two ways, directly or indirectly. Let's see how. Direct investment. People who wish to gain exposure from equity markets and have some expertise in choosing individual shares and can devote time for monitoring their portfolio can buy equities directly. They can do so via the stock exchanges through a stockbroker. As equities trade on the exchange in the secondary market, you can buy a stock directly from the exchange. You can approach your stockbroker who may buy on your behalf and get the stocks credited in your demat account. Initial public offering. When companies approach markets to raise capital, they do it through a public issue. The first time issue of shares by a company is termed as initial public offering, more commonly referred to as IPO. For this, you can fill in the respective application form and await for the allotment. The number of shares allotted to you will be credited to your demat account. Indirect investment in equity. People who lack expertise of choosing individual shares and find it hard to devote time for monitoring their portfolio can take the services of investment managers. Investment managers help investors indirectly hold exposure to equity markets. They can do so via mutual funds. Equity schemes offered by mutual funds help investors to take the benefit of equity investing. Mutual funds are cost-efficient instruments that carry expertise of professional investing and managing money on behalf of investors. As mutual funds work on the concept of pooling in money, there are multiple investors who jointly benefit from gains and losses. You can invest in mutual funds with as low as Rs 5,000. Portfolio Management Services (PMS). Portfolio management services are offered to investors under which the portfolio manager buys or sells stocks and creates a portfolio for the investors. The portfolio manager charges a fee for this service. PMS services are regulated by SEBI and portfolio managers are required to comply with the regulations framed thereto. PMS are usually more expensive than mutual funds as the minimum ticket size for investing through PMS is quite large. Well, equity markets are a good choice for earning high returns over the long run, but do remember that high returns do entail high risks too. It means you need to put your money at some risk and you cannot always expect preservation of capital. And so to reduce the risk or to preserve your capital, you need an asset class which performs the function of preserving or protecting your capital from eroding or turning negative. It is not something new we are talking about. Instead, this is a traditional asset class which existed even much before equities became popular and exciting as an asset class. Yes, this brings to us our next asset class in today's session, debt. Debt means loans. It is the money the lender lends to the borrower. In other words, we can say that debt is an obligation or a commitment from the borrower to repay the money borrowed from the lender. Debt investors lend money to issuers at a pre-decided coupon. In debt markets, the investors invest their money in the form of loans to the issuers, who are usually banks, company or a government, at a pre-decided coupon rate. On maturity, the issuer returns the principal to the investor. When the bond matures on the due date, which usually ranges anywhere between 1 year to 30 years, the issuer gives the original investment or the principal amount back to the investor. Advantages of debt investing. Preservation of principal. Debt markets, as compared to equity markets, are less prone to wild swings and volatility. Some conservative investors invest in debt markets for safety of principal and assume they are completely risk-free. But the truth is, though debt markets are suitable for conservative investors, there are some risks attached to debt market investing, which we will cover in detail a little later. An investor can expect some safety of principal if he intends to hold the bond till maturity. As some bonds are riskier than the others, the safety of principal depends on the credit profile of the issuer. You should check the rating offered by the independent rating agencies to the issuer before investing in a debt market instrument. Then the next advantage is regular flow of income in the form of interest payments. As a debt investor, you are entitled for regular flow of income in the form of interest payments by the issuer. Many investors buy bonds for the interest rate they offer. For example, a rupees 1 lakh bond with a 8% interest per annum pays rupees 8,000 in interest each year until the bond matures. The interest offered by instruments vary depending upon the credit ratings. Capital appreciation. Bonds trade in the secondary market as well. Bond prices and interest rates have inverse relationship. Bond prices rise when interest rates move down and vice versa. An investor can make money in debt markets by buying bonds when interest rates are high and sell them when interest rates fall, thus making capital gains on the money invested. But do keep in mind that investing in bond for capital gains is much riskier than holding them until maturity. Reduce portfolio risk. As we said, holding bond till maturity is less risky than trading them for capital gains. You can earn regular flow of income by holding a highly rated bond till maturity. As debt markets are known to be relatively less volatile than equities, debt investing can help with diversification and stability to one's investment portfolio. Helps economic growth. India's debt market is one of the largest market in Asia and serves as a useful source of banking channels to meet their financial requirements. As issuers, that is banks, companies or government, raising capital in the form of borrowing from debt markets, money raised for any productive activity helps in economic growth. While in equities, such capital raising offers ownership, in debt markets, such capital raising offers regular return in the form of pre-decided interest rate. Even your bank fixed deposit are a kind of debt which offers you a fixed interest rate, and the deposited money is used by the bank for lending to corporates and other individuals at a higher interest rate. But there are some disadvantages of debt investing. The first is low inflation adjusted returns. Historically, debt markets have been less rewarding as compared to equity markets. As debt instruments are considered to be a low risk, low return investment proposition, people prefer debt more for safety rather than capital appreciation. While on one hand you can expect getting assured returns, on the other hand these returns would be low. Issue with price discovery. As the retail debt market in India is not well developed, retail investors find it difficult to track prevailing prices of their debt holdings. For returns from their bond holding, retail investors rely more on regular coupon payment rather than looking for prevailing market price of their holding. Thanks to the debt mutual funds, which help retail investors participate indirectly in bond markets without worrying about prevailing market prices. Then the next disadvantage is interest rate risks. As bond prices and interest rates are inversely related, bond prices fall when the interest rates rise and vice versa. Debt markets quickly react to any policy action taken by the central bank. The expectation of interest rates leads to change in sentiments and impacts the market-linked debt portfolio of investors. So while debt markets may constitute to be safe in terms of assured flow of income, they are not safe in terms of prevailing market price. To make your debt holdings safe, you need to hold them until maturity, but you may forego an opportunity of making intermediate capital gains. If you invest in debt markets considering it to be absolutely safe, Do not forget that it may even surprise you in unfavorable conditions. Then the next is credit risk. Issuers in debt markets have their credit worthiness, which is measured by rating agencies. Before investing in any debt market instrument, you should check the credit rating assigned to the issuer. You should not fall for high returns on offer. Issuers with low rating need to offer high interest rates to attract investors, while issuers with high rating would offer low interest rates to the investors. Low credit rating means more chances of a default, while high credit rating means a less chance of a default. So debt investing is suitable for conservative investors. As debt markets are constituted to be less volatile than equities, they're preferred by conservative investors looking for safety of their capital. In fact, your safety to capital depends on the kind of instrument you're having an exposure to, your holding period, likewise your maturity profile, etc. You should select your debt investments based on the investment time horizon. Say if your time horizon is less than 3 months, you should not hold a longer maturity instrument, as it may have high volatility in the near term. Investors looking for regular flow of income. Debt markets help in generating regular income as they offer exposure to income generating instruments like government securities, bonds, non-convertible debentures, fixed deposits, etc. As credible debt market instruments pay regular interest while keeping your principal intact, debt markets are ideal for investors looking for a regular flow of income. Investors whose goal is approaching. When you have your goals approaching, preservation of capital becomes your priority. You would prefer to keep your money safe so that you do not fall short to meet your commitment. Unlike equity markets, which may be highly volatile in the short term, debt markets provide you with investment avenues to park your money even for a short span of time. Short-term debt instruments or even liquid mutual funds are ideal category to park your very short-term money while keeping your principal relatively safe. So there are various avenues to invest in debt markets as well. The first is bank fixed deposits. Bank fixed deposits are the most common debt market instrument in India. Bank fixed deposits are very common among investors as the traditional investment avenues for decades. As we said earlier, your investment in bank fixed deposits is a kind of debt which offers you fixed interest rate along with safety of capital. Fixed deposits up to ₹1 lakh are covered under the DICGC, that is Deposit Insurance and Credit Guarantee Corporation. The tenure of bank fixed deposits ranges from 7 days to 10 years. Then the next is corporate deposits. Corporate deposits are nothing else but fixed deposits offered by a company or an institution other than a bank. Over here, the interest rates vary depending upon the credit quality of the issuer. Independent rating agencies assess the credit quality of the company and assign the rating indicative of risk involved in the investment. Thus, higher the credit rating, lower is the interest rate offered, and vice versa. However, sometimes companies raise money without securing a credit rating from independent rating agencies. In such cases, companies often pay higher interest to attract investors. Corporate bonds and debentures. Corporate bonds are issued by public sector undertakings and private companies as well, for a wide range of tenure, normally say for a period of 1 year to 15 years or even more. Don't forget, corporate bonds may turn out to be risky. The riskiness depends on the issuing company's credit rating, the business into which the company is in, the sector in which the company operates, and the prevailing market conditions. You need to consider the credit rating of a bond before zeroing on a bond or a debenture for your investment. Government securities. G-Secs or Government of India dated securities are units or debt papers issued by the Government of India in lieu of borrowing from the market. Government of India issues a certificate through the RBI acknowledging a receipt of money in the form of debt, bearing an interest rate. Government securities include all bonds, T-bills, and instruments issued by the central government as well as the state government. These securities are normally referred to as gilt-edged, as repayment of principal as well as interest are totally secured by sovereign guarantee. Small savings offered by government and post offices. The Government of India has framed various small savings to provide secure and attractive investment opportunities to the public and use this as a resource for development of the country. Even today, the post office is one of the largest savings institutions in the country and plays a vital role when it comes to savings. It offers various saving instruments to the public, which even provides numerous benefits to investors. Some of the major instruments of post office schemes also offer tax exemption benefit to investors. Public Provident Fund. Many of you may be aware of the term PPF. Public Provident Fund or PPF is used as a savings cum tax saving instrument in India, as it is used as a tool to save for one's retirement, especially for those who do not have a structured pension plan covering them. As per the current laws, you can invest a maximum of ₹1 lakh per year in PPF. PPF offers you a fixed interest rate every year, which helps your money grow on compounded basis each year. Many nationalized banks and now even some private sector banks are authorized to open PPF accounts for individuals who are residents of India. Debt mutual funds. Today, there is a plethora of investment options available under the category, which makes it very difficult for you to choose from among multiple bank deposits, hundreds of corporate deposits, thousands of small savings schemes, etc. As it is nearly impossible to invest in multiple debt instruments, debt mutual funds provide you the advantage of taking exposure to multiple fixed income instruments through a single investment product. Their primary objective is capital preservation and income generation. Your time horizon as well as your liquidity preference is of utmost importance while selecting the right debt mutual fund for you, as the portfolio structure and maturity structures differ for various categories offered by debt mutual funds. Now that you may have obtained a better picture of investing in debt, let us take our next and the most popular asset class in today's session, gold. Gold as an asset class requires no introduction. We come across and even use this precious metal in our day-to-day life in some or the other form. But do you know why gold is a critical asset when it comes to investing? We will tell you why. Gold is a precious metal. In true sense, gold is a precious metal. Why? This is because it carries a store of value. In contrast to the other major asset classes such as equities, which derive the value from the underlying business, or real estate, which could provide rental yields for you along with a potential of capital appreciation, or debt which pays regular interest, gold possesses no such distinctive characteristics. But having said that, let us apprise you that it is considered to be a store of value, as it enables you to combat rising cost of living over the long term and therefore acts as a hedge against inflation. Historically, gold has been a valuable and highly sought after precious metal for making coins, jewelry and ornaments, and is so precious that we even store gold in our walls and lockers in the form of bullion, coins and bars. Gold is a vehicle to monetary exchange. Globally, gold is widely used as a vehicle to monetary exchange, and the money flowing in the global monetary system is some way or the other attached to gold. How is gold put to use? Different people may have different reasons for buying gold, and here are a few reasons why people like to buy gold, and some even put them to use. First is store of value. As we just said, gold is a long-lasting metal which can last for ages. It is a precious metal and has been used for exchange and has lasted as money for centuries. It is used as a reserve currency. Having store of value, central banks and governments of various nations aim to maintain gold reserves in order to secure their positions. central banks use these reserves as a guarantee to cash in their promises and pay their depositors and note holders. Hedge against economic pressures. Gold, being a precious yellow metal, is used as a hedge against financial distress like inflation, deflation, and currency devaluation. Due to frequent changes in the supply of money in the system, the value of currency can inflate or deflate. Hence, holding gold can help one hedge such risk of devaluation of money which might be lying in their bank accounts or lockers. Industrial demand. Though not as high as silver, gold has some industrial demand and medical demand too. Jewelry and ornaments. India is one of the largest consumers of gold. People in India have special fascination and emotion for gold. They buy gold especially in the form of jewelry on auspicious occasions like marriage, festivals, and social events. Many Indians like to pass on their gold to the next generation in the form of jewelry or ornaments. Investment. Purchase of gold jewelry may not always be termed as an investment, as people hardly sell their physical jewelry to book profits when prices go up. Conventionally, for investment purpose, people prefer to buy gold bars or gold coins in physical form. Portfolio diversification. Gold is termed as a hedge against inflation and has the ability to take care of loss in purchasing power of money. In conditions where productive asset classes like equity, debt, and real estate face the risk of losing value due to fall in currency value, gold can come to rescue. Also, if these productive asset classes are unable to compensate investors with inflation-adjusted returns, then the demand for precious yellow metal like gold tends to increase. Hence, it is recommended to hold a small portion of gold in one's investment portfolio, thereby diversifying risk across asset classes. Pledging for emergency needs. Many banks and gold financing companies have started offering secured loans to individuals who wish to pledge their gold at a reasonable interest rate for a pre-specified tenure. The interest on such loans is lower as compared to personal loans, so gold can be used for raising short-term finance for a nominal rate. Individuals with gold lying idle in their locker can pledge their gold to meet their short-term financial needs. Thus, it is not necessary to sell your gold to raise money in case of emergency. How to invest in gold? Well, broadly there are two ways of investing in gold. Conventional ways of investing in gold and the unconventional way of investing in gold. The conventional way of investing in gold is through the physical form, jewelry, coins, and bars. Many investors prefer to invest in gold the conventional way. Yes, you got it right, by purchasing gold in a physical form, that is in the form of gold jewelry or coins or bars. As buying into the precious yellow metal is driven by emotions, many often prefer to invest in gold the conventional way, as they can touch, feel, and see their gold holdings. While you can buy gold in the form of jewelry, coins, or even bars from your jeweler, you can also buy gold, coins, and bars from your bank. But buying gold in physical form may have its disadvantage like high storage costs, quality issue, purchase at a premium price, resale at price lower than the market price, leading to low resale value, etc. So to avoid these issues, investors are gradually shifting towards unconventional ways to invest in gold. The unconventional way of buying gold facilitates you to invest in gold in a non-physical form, that is either through paper form or even the non-paper form, which is the electronic form, but they offer the advantages of investing in gold. Such investment options are gold exchange traded funds, gold ETFs. ETFs are instruments offered by mutual fund houses and are listed on the stock exchange. They represent ownership in an underlying security, commodity, or asset. Hence, to put it simply, a gold ETF is an instrument that represents an ownership of gold assets. When you buy a gold ETF, you get a contract indicating your ownership in gold equivalent to the rupee amount of your investment. Gold ETFs are listed on a stock exchange, and you can buy or sell them on a real-time basis. But to own them, you need to open a demat account along with share trading account with a broker. Gold funds. Gold funds are a relatively new breed of unconventional way to invest in gold. Gold funds are generally fund of funds schemes which invest their corpus into an underlying gold ETF. These funds attempt to provide returns that closely correspond to returns of gold as an asset class. Unlike gold ETFs, where you hold units in your demat account, in gold funds you have an option to hold units in a physical form as well. Moreover, gold funds, apart from lump sum investing, offer a systematic investment plan mode, which is effective and a convenient way of investing in gold regularly. Holding gold in an unconventional form like gold ETFs or units of gold fund offers advantages like convenience, low storage cost, fair purchase and resale value, favorable tax implications, amongst host of others. So here are some key takeaway points for our today's learning session. First is equity. Equity means ownership. Equity entitles you with partial ownership in a company, and you can participate in company's growth. Equities help you earn through dividend as well as capital appreciation. Equities have the potential to generate returns higher than inflation. Do not forget, for equities to generate returns higher than inflation, one needs to stay invested for long term. Equity does not guarantee return. Equities do not guarantee any return to investors. The return on one's equity investment depends on the performance of the company. Equity investments carry risk. While investing in equities, you may be tied by risk of capital erosion. You can invest in equities in direct form or through indirect form, which we have discussed earlier. Likewise, for investing in debt, remember debt offers preservation of capital. Being less volatile vis-a-vis equity, if invested prudently, debt can provide a level of safety to your capital. Debt is ideal for generating regular flow of income. Debt offers pre-specified coupon payments which help investors with regular flow of income. Debt offers low inflation adjusted returns. You may find debt markets boring as it offers low returns, but do not forget that they may offer preservation of capital too. There are some risks associated in debt markets. You cannot avoid interest rate risk and credit risk while investing in debt. Bond prices and interest rates are inversely related. When interest rates move up, bond prices move down and vice versa. Select your debt investments wisely. While investing in debt, you should consider your investment time horizon and identify the debt instruments wisely. Then the next is gold. Gold is a precious metal and has a store of value. Gold is a hedge against inflation, and it can come to your rescue during crisis. You can hold gold in physical as well as non-physical form. You can choose to either buy gold bars and coins or hold it in your demat account in the form of mutual fund units. So to end our today's learning session, we now invite you to test your learning by taking up this simple quiz and win exciting prizes. Thank you for participating. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.